many people don't realize is it's worth more than rupees 238 lakh crore. Bonds. Something much simpler and much more structured. When we talk about financial markets, most people immediately think of shares, stocks, Sensex, Nifty, market movements, volatility, etc. etc. That's usually where this conversation begins. But what many people don't realize is that a very large part of the financial system actually runs on something much simpler and much more structured: bonds. In fact, India's bond market is massive. It's worth more than rupees 238 lakh crore, or about rupees 2.78 trillion US dollars. And yet, we don't really talk much about this. Most of the attention still goes to the stock market. But the bond market is actually larger, and it plays a very important role in how the economy functions. If someone takes a little more time to understand how the Indian bond markets works, a lot of things start becoming very clear. You begin to see more options. You understand where the returns comes from. And investing starts to feel more easier and less confusing. So let's do that. Let's start from the beginning. What exactly is a bond? A bond is a debt instrument. In simple terms, it is a loan. When governments, companies, or institutions need funds, one way they raise money is by borrowing. When that borrowing is done formally with defined terms and proper documentations, it is called bond. So, when you buy a bond, you are not buying ownership. You are lending your funds to the issuer. In return, the issuer agrees to two things. First, to pay interest at specified intervals. Second, to return the principal on a fixed date in the future, that is, the maturity date. Everything is defined upfront. This distinction matters. Bonds operate on clearly defined terms. Now, when a company or a government needs funds, there are broadly two ways to do that. The first way is equity. This means selling ownership. What we commonly call shares or stocks. When you buy a share, you become a part owner of the company. You participate in the future upside as well as the downside. The second way is by issuing debts. This means borrowing funds. The company or the government chooses to not to give up their ownership and instead raise the funds by borrowing. And the instrument used for that borrowing is what we call a bond. So a bond is simply a formal contractual agreement. The issuer commits to repay the borrowed amount on a specified date along with the interest, as per the agreed terms. Imagine this. You lend rupees 1 lakh to your friend Rahul at 8% fixed interest rate per year. Rahul says, I'll pay you rupees 8,000 every year as the interest. And at the end of the year, he will pay back the principal amount of rupees 1 lakh. That is exactly how a bond works. The only difference here is instead of Rahul, it's a company or the government. Instead of verbal agreement or the promise, it's a written contract between a lender and the borrower. Next, we'll slowly build on this and discuss what's the difference between bonds and shares.